critiquing where we're starting from and contrasting what we're trying to do with cycles will be helpful. So one, existing payment systems are not designed from first principles. They've just been cobbled together over the centuries, primarily in response to liquidity crises that have been plaguing us for hundreds of years. In contrast, what we're trying to do with cycles is really start from first principles, build a payment system from first principles. Two, and this is sort of related, risk management in our payment system, in our financial system, is primarily architected around central banks and lenders of last resort, which concentrate systemic risk and moral hazard at the heart of the system. And even the godfather of the lender of last resort design, Walter Bagehot, who wrote the book on this stuff, does not think this is a good system. But nobody will tell you that, except for me, apparently, or if you actually go and read the book, which I'll encourage you to do. It's called Lombard Street. So with cycles, we're actually starting from a position of how do we reduce risk in the payment system by thinking about the network structure that already exists, the network structure of debts, and take a more preemptive approach rather than the reactive approach to managing liquidity and mitigating crises. Third, there's a profound overemphasis on transfer and exchange of assets. And we're guilty of this in crypto as well. But the reason transfer and exchange of assets is important is because of the underlying debt that you're ultimately trying to discharge. If you're not engaging in debts, in obligations, you're not participating in the real world, frankly, right? Everything we do involves obligations to each other. So much of life is, paying rents and paying wages and paying bills and paying invoices and trade credit, all this stuff, right? And we don't represent any of it in the structure of our payment systems. It's over-focused on the asset side. And again, we're missing out because there's structure in the debt graph that we can take advantage of, as we'll see. And of course, that's part of the design of cycles, is to actually surface that graph of debts and do something about it. Fourth, so much of our financial architecture is built around financial intermediaries and novation. Novation means changing the counterparties in a contract. Things like securitization and factoring, where you're mutating risk, right? What we're trying to do with cycles is instead use novation as a last resort. Try to do as much as possible with the existing structure of the graph of liabilities out there in the world, respect that graph, so to speak, before we try to do things like securitize debt or transmutate risk in these weird, complex ways that involve intermediaries and so on, which would resonate with a lot of blockchain people. Fifth, so much of the system is designed around market-making dealer intermediaries that are short volatility, that have to get bailed out by central banks, and that we're obsessed with this idea of providing liquidity into the market, right? I gave a whole talk on this at the Modular Summit called Defund the Dealers. I encourage you to check that out. In contrast, what we're trying to do with cycles is focus on the idea of liquidity saving rather than liquidity provisioning, taking advantage, again, of structure within the graph of debts to save liquidity rather than depend on these dealer intermediaries. And again, the idea is that we can actually defund the dealers to a significant extent. There's a wonderful book on this topic called The End of Finance that really contrasts these different paradigms of liquidity providing and liquidity saving. Finally, the problem of issuance, right? So much of the world's money is issued by commercial banks. A lot of us are over-focused on the money issued by central banks. I think that's much less relevant. In the cryptocurrency community, we're interested in issuing tokens to miners and validators, liquidity providers, and so on. But there's a lot more to really explore here. And as Hyman Minsky, a great economist, said, it's easy to issue money. It's hard to get it accepted. And with cycles, we're really trying to capture the nature of that problem by formalizing what it means to accept a currency, to enable us to design new kinds of currencies and issuance mechanisms that empower people and communities in ways that currently only banks are empowered to issue money. So this was a lot. I hope you don't feel too overloaded. If you need just
It was a lot to get people going with today on payment systems. We're here in the Global Financial Systems Fireside. We're going to get to a lot of topics, and we're really lucky to be joined by Zain Bacchus today, who's a good friend of mine and has been doing great work across the Ethereum, Solana, and overall crypto ecosystem, building a better financial system in many different ways. And so we'll get to Zain quickly. We started here with Ethan Buckman. We've been referencing cycles because we think that the work that he's doing started in the Cosmos ecosystem, most recently funded by Paradigm, also involved with like Circle and the stablecoin architecture there is really broad and perhaps paints a picture of how broad one could go in trying to redesign or at least respect the broadness of the topic of the global financial system and all of the different ways to talk about it. In this case, the critiques were specific to payment systems. And because it went really fast, We, you know, can get back to some of these later, and I put the YouTube video in the chat, but it does reference some of the work in this module. We're gonna skip ahead a bit on office hours and on some of the specifics of logistics. We'll get back to those to focus in on the topics of the day. And today is a fireside, so we'll be spending at least 30 minutes with Zain, focused on some of his ideas and and maybe whiteboard style, get some ideas together on the global financial system. Um, the starting points that Kernel comes from are that uh, this topic is probably the most complex topic that we tried to cover in 1 week in kernel. And as a result, we get back to this module on better questions. Um, there's a really nice link to unsolicited life lessons from a man named Kevin Kelly, who is a technologist that we really appreciate, who uh, in the 90s or perhaps even before started Wired and uh, some other work he's done in the technology space. But he talks about the simple, silly questions that can be profound, the good questions coming from a sincere desire to learn. He says the experts rarely ask good questions. Be a beginner always. Own up to what you don't know. It'll set you and others free. Close listening and clear attentions are preconditions for good questions. And a real master is a pupil in the eyes of the world. Don't be afraid of letting others teach you. It does not degrade you, it uplifts you. The ego doesn't always acknowledge this simple truth. So, better questions helps us a lot when talking about money, because on one hand, each of us feels like perhaps we should know a lot about money. And then when you start to look at it, you're like, wow, there's like a lot going on here. So at least for today, we're going to start by peppering Zane with some questions about what he knows about money, and try to use that as a kicking off point for broader dialogue. As always with Firesides, your questions and the questions of the group are going to matter more than anything that I have. So please feel free to chime in, raise hand using the Zoom feature, and we'll get into it. Um, I think the only thing that I wanted to share about some of the prep materials was that um, yeah, there's again many different lenses to attack this module, and we won't get through all of them today. Um, in the module, there's a Nick Szabo piece on recollecting our origins, which is referenced on the right side of this slide, where he kind of talks about where the word economy itself comes from and what some of the precursors to money were, that allowed for cooperation that other animals could not, took much more of an anthropological approach to how money came to be. Um, Another anthropologist, David Graeber, wrote a famous book called Debt that I know Vitalik and the Ethereum ecosystem referenced a lot, and has been relatively influential on the understanding of how debt has grown over time, and how that's impacted the modern monetary system. And then an entire series from a man named Perry Mehrling on what's called the natural hierarchy of money, which tries to tackle some of the ways that you could look at the modern banking system and how money grows. And so this modern monetary pyramid, sometimes we show it as like a pyramid that expands in times of boom and then contracts in times of credit shrinkages. And this elasticity between those two happens in all scales. It happens every day, it happens in every business, it happens every season, and in the rise and fall of nations as the lender of last resort, as is described in the video by Ethan. Um, With all that broader context, though, we want to zoom in on what's been going on in crypto. And we have Zain here to help us try to approach this question and to try to do it in a relatively customer or user or person centric way. Like, what is happening in crypto that is helping to improve upon this financial system in different ways? Zain is somebody who's taught me perhaps the most about what's actively happening in DeFi, not only in the Ethereum ecosystem, but beyond into what's been going on in Solana world and the opportunity that is in front of us as builders at this moment in time. He leads product at Helios, which I'm sure he can talk about in the course of this conversation, but um, I just want to start with a couple um, beginnings, I guess, here. And we'll start with this tweet then and with the question on the global financial system that we kind of talked about a little, or at least shared in the Q&A. I want to talk about the global financial system as you know it, um, maybe pre-crypto, and then relate it back to this chart of, okay, like where are we in crypto? What has been happening, and what does this chart represent to you in terms of crypto's impact on that global financial system? Thanks for being here, Zane.
Yeah, of course. Howdy, everyone. I like the pleasant time zones all in good local time. I'm gonna steal that going forward. Before I get into it, can everyone share where they're from in the chat? Because given we're talking about global trade, would be interesting to know where everyone's dialing in from. Zurich, Colorado, Toronto. I'm Canadian, by the way. SF, Bay Area is so back. Kenya, amazing. New York City, Brazil, Argentina, Vancouver, Iran. Okay, fantastic. So when you think about sending payments today within your own country or your own locality, it's pretty easy, right? I can send my mom, she lives in 3 hours away from me in Texas. I can send her payments via Venmo or, Chase Pay or something like that. But then Skelly, he's over in Argentina, and I have no way to send Skelly any money, until crypto came around. Now, why is that? I think what we saw back, I mean, and what we still see today is we have a bunch of fragmented payment systems, Vivek, that the video that you were sharing talked about earlier on. And those webs of payment systems were kind of cool, right? Because it enabled global commerce to happen. So I could send Skelly money via a bunch of intermediary banks, and eventually Skelly would get the money a few days later. And ideally, both my business would grow, his business would grow, and the entire GDP of the world would grow. So it did a darn good job of going 0 to 1. And I think we should all respect that around like, okay, these humble beginnings. But then, guys, it's 2025, and still, unless like I can't send Skeletor money via my bank and have it land in his wallet, at the speed of light or at the speed of the internet, which is kind of weird, right? So I think today there's a word that will keep coming up is like this term of capital efficiency, which is effectively how much or how quickly can you turn over or use a dollar or your local currency. And when you think about what this inning of crypto is about, I think it's about unlocking capital efficiency within the global markets. So the image that you were sharing, Vivek, from DeFi Llama, and actually that data turns out to be, it was incorrect on that timestamp. But yes, we have broken a DeFi all-time high recently. But that image really shows the early innings of capital efficiency being unlocked across the global stage. So I'll just summarize it with this. Like today, we have at best T+1 settlement, which effectively means if I do a trade, I don't have those funds in my account to actually reuse for another trade until the next day, right? And the reason that is because of this lack of coordination layer that exists between, different exchanges or different governments or stuff like that. And with crypto, with blockchains specifically, we get near instant settlement. So once that transaction gets landed on the ledger, I can then go and reuse my that dollar for whatever that might be, whether that's paying vendors, executing another trade, or stuff like that. So, anyways, I'll pause there and happy to get into any specific questions.
Yeah. And feel free to chime in, anyone. Please raise hand. We'll just get you in immediately to hear from anyone who has questions for Zain. Can we do one more dive deep to this T+1 to near instant? Because it matters, I think, a lot to this value acceleration idea and capital efficiency idea. Um, Tell me about like, yeah, this reusability, this efficiency gain in practice. Like, what does it mean for people and people who like to use their money well?
Yeah, yeah. And John, happy to do that. Does anyone have a brick and mortar business like a coffee shop or something like that? Um, Sell clothes, anything? Or are we all working in the internet of value?
I have a brick and mortar business.
John, what's your brick and mortar business?
Uh, I own a sauna that I rent to people by the hour.
Amazing. That's John, I can't remember where you're living, but that is super on trend, and I'm sure your company's doing phenomenally well. Um, cool. So John has a sauna business where he rents out per hour. So what is happening today when a customer goes to John, rents out, let's say 2 hours of sauna time? Today, what happens is let's say I'm doing it. I'm going to John's business. I'm going to swipe with my credit card or my debit card. Let's say it's $50 for an hour. John effectively in his business bank account for his sauna business gets an IOU from Zain that says Zain paid John $50 in IOU credits. Pretty decent. It works. John's like, hell yeah, Zain, go use your sauna. So Zain, I'm gonna go enjoy my sauna time. But let's say John needs to go pay his employees who's running the business, or he needs to pay his vendors, whether that's someone who has is providing electricity or something like that. Well, John, technically he could provide an IOU, but that's going to cost him more money to provide an IOU to pay his employees out. But if the money settled instantly, what John could effectively do instead of waiting days to pay out his vendors or his employees, he could take that money and pay his vendors or his employees immediately. So this concept of reducing the window of capital reusability is what I'm alluding to when I'm talking about capital efficiency. So you can think about it. Maybe I don't want to go too deep into DeFi yet, but another example of this is like within DeFi. Does anyone know what a flash loan is? If you just want to drop yes or no in the chat. No, no. Okay, no, no. Okay, cool. A flash loan is effectively a mechanism that you can use on Aave or something like Camino on Solana, where you can borrow a bunch of capital, and within that same transaction that you're borrowing the capital, you can execute an arbitrage opportunity and then repay the capital. Um, the reason flash loans are really unique for crypto is because the capital efficiency of it is really damn high. Why? Because let's say I'm borrowing $1 million from Aave to execute a flash loan. I only have to pay back, a few bips because I'm only borrowing that capital for that duration of time, right? So you could ultimately argue a flash loan from Aave is much more capitally efficient than Zain going to JP Morgan saying, hey, can I borrow $1 million? Them doing due diligence on me. That's one day that the trade window is passing. Second day, they're sending me funds. Now I have to wait a third day for the funds to settle. Fifth day to execute the arbitrage. Sixth day, oh, that's a weekend. Seventh day, that's a weekend. Eighth day, repaying back, right? So now, as someone who's trying to capture an arbitrage trade, I have to pay that loan duration for 8 times or even longer, but effectively 8 days for borrowing that capital versus something like using a blockchain where that value could be settled instantly and I'm only paying for the duration of that loan. So in summary, what does capital efficiency mean? It's just how frequently can you turn over that dollar or use that dollar within, let's say, a day or a period of time. That's the
Amazing.
easiest way to think about it.
Amazing. Amazing. We've spent a good amount of time on payments, and of course, payments ultimately, like we talk about pre-crypto, the web of banks, brokers, and clearinghouses that were passing these IOUs. The trust that was built through those banks for contracts and regulations. Now, the ledger itself can contain some rules, and there's some added potential stability and efficiency and trust that saves us time. Um, the the idea here also that Zain you're like alluding to is that the trust comes from the ledger itself, and that ledger is a unique thing in our time that this ledger can be used. And so um, my My next question is about like maybe moving from payments a bit broader. I think that um, just a slight bit broader would be to go into things like stable coins and MEV and maybe some other things that we've been seeing in DeFi that have been exciting to you. Um, I think that if you're up for it, we could start there.
Yeah, let's do it. And I also want to come back to what John said in the chat, which was effectively like, okay, we're going from a system or market of intermediaries to a new set of intermediaries. I think the biggest thing that we're going towards is instead of stitching to multiple types of banks and settlement exchanges together, right? We all have an open API that we can compose against and use that shared ledger that you were talking about, Vivek, as a way to get from T+1 settlement or longer to instant settlement or near instant settlement. But yeah, happy to talk about stablecoins and MEV.
I had a question. Do you mind if I go now?
Please.
Um, so Zane, hey, nice to meet you. The stuff on payment efficiency is really interesting. But I think what Vivek is alluding to is kind of the question of value in the financial system, right? Like, in what sense does the crypto economy replace the existing financial system as a more trustworthy store of value? And what I'll put to you specifically that I'm curious about is if you're familiar with Jeff Booth. I think he talks about how the natural state of the free market economy is deflationary. I mean, it makes sense to me, but he's really the only person I've heard saying that. Do you have thoughts on that? And does the new crypto economy kind of, hold up in that respect? Is it a Bitcoin specific feature, or is it something that applies across the board?
Oh man. Okay. This is going to be a heated topic. Okay. Everything I say is just my own opinion, does not reflect the views of my employer. But Nitesh, to your first question around is crypto going to replace the existing financial system? I think my bias would indicate no. Crypto is not going to replace the existing financial infrastructure. However, crypto and blockchain technology, whether it's stablecoins or that shared ledger, will improve the capital efficiency of existing markets and existing financial infrastructure. Um, what do I mean by that? And effectively, banks, brokerages, even brick and mortar mom and pop shops, they'll become more profitable because they don't have to wait for value to get settled in days and it'll get settled instantly and they can reuse that capital. I think that as end users, right, as retail users of a bank or a brokerage, we'll also see benefits, which is resulting in lower fees as well as better yield or returns on our own capital, whether that's dollars. I think a good example I want to point to is actually Vivek and one of his good friends, Mark Balin, are the guys that pilled me into joining the industry from big tech. And the thing they talked to me about was this idea of democratizing financial access, right? So what I understood that as back in the day was, okay, sorry for the US centric analogy, but everyone, regardless of income level, regardless of geography, gets Chase private client access, which is effectively just like you can imagine, sophisticated tooling, better yield, better financial tools if you have X wealth for this major bank, right? So effectively, everyone gets those tools. And I really didn't see any of that democratization of financial access happen until this year with better US regulation. So if you have Venmo in the US, if you go to your Venmo app today, you can effectively change your balance into their own stablecoin called PYUSD. And you can effectively get the risk-free rate, aka that 4% that the US government is paying out on treasuries, immediately accessible and start earning that. That is really powerful because even as someone who lives in the US that has access to good payment tech, most banks, most brokerages are paying 1 bp, 10 bps. Now everyday users are getting 400 bips on their balance, right? And they're getting access to that. That 400 bips was always there. It was just a non-competitive market where, okay, it didn't make sense to pass it on to retail. But now because of these primitives and because of the capital efficiency gains, some of this is being able to get passed back to the customer. So Nitesh, I think the way I kind of summarize this is while decentralization is extremely important, it is not the tip of the spear for why banks or large institutions will be adopting crypto in this near term. It'll be because of this capital efficiency gain and effectively a way to make more money.
So sorry, gotcha. But did you have a reaction on kind of the thesis that crypto can usher in a deflationary economy? Because, to your point, sure, they're getting the faster payments, but if I get $100 today, but the banks can just issue more money, the value of my $100 doesn't hold up. And that's really beyond my control. I think that's the issue with a centralized economy that I understood to be the promise of a decentralized economy. So are you pessimistic about that benefit?
No, I'm generally an optimist. I think
Specifically with respect to that.
yeah. I'm pragmatic in the take that um, I think let's level set the conversation. I think specifically what you're alluding at is central bank controlled currencies can be inflationary if the government chooses to spend beyond their means. And with something like a crypto native asset, whether that's Ethereum or Bitcoin, or even an asset that one of us creates ourselves, it could be deflationary. And that is potentially better money because it's deflationary. Is that what you're getting at? Is that like your thesis or?
If I could add to it in the context of this talk that I put on early, Ethan's project is called Cycles Protocol, a peer-to-peer electronic clearing system. He comes from kind of like a deep Bitcoiner mindset and spent a lot of time in Cosmos world working on as the founder of Cosmos, and then now is spending most of his time on Cycles. And the suggestion on number 2 here, this risk management via central bank, lender of last resort, the idea that like the central bank has to be the tip of the spear. This also comes up in this module because you get into this like, well, how does this like hierarchy of money work? Where do we start from both the um, the central banks and then the commercial banks and all of these clearinghouses and IOUs that Zane you were alluding to. And what Ethan says is that what really drives the action and hence the power in the banking system is the liability side of the balance sheet, not the assets. Banks have for a long time participated in these clearinghouses from which most people are excluded and through which they settle enormous amounts of debt with very small amounts of actual money. And this idea that like banks have access to these interesting and meaningful solutions like clearing debts without the necessity of money. But like, of course, for us to participate, like the best that we are offered, oftentimes is at least they can offer us the 4% that the Federal Reserve is giving us, but they still have access to these clearing functionalities and maybe perhaps some uniquely uncompetitive things, Zain, to use some of the language that you use. Like they don't have any competition when it comes to clearing. And because of that, they have more control over debt and how debt is both issued and cleared. Nitesh, do you have any like additions or thoughts here?
Yeah, no, I agree with that. And I think, Zain, you said that inflation kind of comes from the government's ability to spend a lot of money, and that's why the supply increases. But to Vivek's point, I think it's not just the government, and this gets left out of US discourse. It's banks that have the ability to create money as well. And in the US, there's limitations on fractional reserve banking. But if you're familiar with euro dollars, something that came up in the 1970s, essentially these banks were setting up outposts outside the US, which gave them the ability to circumvent those fractional reserve limits and create a whole lot of money. Um, there's this question about how much USD is out there. The Treasury doesn't know. But to Vivek's point, banks can go out there and create money. So do decentralized options give us the ability to, build more trust? Or is a fixed supply of cryptocurrency, as in the case of Bitcoin, a potential solution to this kind of, fiefdom that banks have to create money?
I would kind of push back that fractional reserve systems are a form of banks printing new money, right? Not talking about the Fed. I think it's a form of leverage, but not printing net new money. Are we aligned on that definition, or would you still say that um, fractional reserves specifically are effectively increasing the denominator?
Well, if the question is what is the, as a layperson, right? Or if I'm running a brick and mortar business, if the question is what is the value of every dollar that I earn, then in that case, I think the money that the banks create on their ledgers are just as good as printed money in terms of increasing the money supply. Because they can go out there and use it to purchase assets that I'm competing for with my hard cash, but they're using this create ledger money essentially to participate in the market.
Kav,
And
I
do
was
you
going to
agree?
say Kaveh may have some additions here. He says it's net new credit multiplier
Yeah.
effect. Kaveh, would you like to expand there?
Sure, can you hear me?
Yep. Yep.
Right. I think yeah, I think Nitish is talking about the multiplier effect, which is like you deposit $1 in the bank, then the bank, well, in the United States, they're required to keep 0% of that, so they can lend out the entire $1 to someone else, and then someone else comes in, deposit it. So now there's $2 of credit in the system, and you can keep going on that. So the multiplier effect in the United States, I think the estimate is about somewhere about 100 multiplier. So one new dollar in the economy translates to about $100 of credit. Yeah.
Yeah, cool. We're aligned there. So when I say leverage, that's effectively what I'm getting at, right? And to your point, Kaveh, the multiplier effect. I don't look. I think we need to understand why. Um, what is it called? Fractional reserves even exist, and I think in part it's to boost economic activity. So it is inflationary to the original point. But I think the question is, okay, if we assume in a vacuum that this financial system doesn't exist and there is an opportunity to completely displace it with a crypto native solution, will that be more deflationary than the existing solution? And I would say kind of point that what exists in crypto native solutions today, which is effectively the same financial games that are happening, right? Which is some rehypothecation that effectively creates synthetic leverage. Exactly. You got exactly where I was going here. So you get the same outcome, and that's like why I wanted to orient the question around the multiplier effect or specifically leverage. So to answer your question, I don't think a crypto native solution would address the inflationary impacts that the existing financial system has.
In many ways, new forms of credit. A lot of that TVL and DeFi, right? It's new credit, it's new looping, and it's an interesting question, Nitesh, because I do think if we think about it a little bit broader about like, like all of the money that's going into AI, one might say like that has like an inflationary effect, and some of the work that's going on in crypto is if it's about efficiency, then efficiency to me is not necessarily about like limiting new credit, but it is some type of deflationary, uh like efficiency and deflationary in this case, I find to be like complementary terms. So it's an interesting discussion.
Yeah, I think the other thing to add is like if your hypothesis is that blockchains improve capital efficiency, and like that is the reason banks are going to adopt it, then we will see a continuation of the existing games and ramifications that those games create. So specifically, right, fractional reserves, maybe instead of 10 to 1, with a blockchain system, they could do 20 to 1 or something like that.
Let's last 7 or so minutes with Zain, like shift a bit to the capital markets side and what you've been seeing in your foray into the Solana ecosystem. What has been positive about that experience? What drove you to make that choice? And I think that you've been speaking a lot about the reasons why you made that jump. But I guess if there's anything else that you would add to, like, I guess the contributions that you feel like are coming from both Solana side, um, in terms of things that haven't been covered. The thing that's on my mind is maybe not even that Solana specific, but the recent point that was made on the IPOs when we look, if we look at the banks as like, okay, the banks are creating all these different honeypots, and how can we like mitigate some of these honeypots with better systems? The one that's come up recently in crypto with the Circle IPO was how much money was left to the bankers, given the mispricing of the IPO. And when I think of the internet capital markets thesis, I think about like that type of inefficiency. Maybe you can just continue to point out some of those that people should be aware of.
Yeah, totally. Okay, so for context, I spent the last 3.5 years focused on Ethereum scaling at a company called OP Labs, which built the OP stack and runs OP mainnet. This summer, I left OP Labs to go focus on high frequency trading infrastructure and general trading infrastructure at a company called Helios, which is a Solana focused company. My bias is I'm not a single chain maxi. I'm looking at, okay, where do I believe capital markets will settle in the future, right? So I truly believe, yeah, we'll see a lot of it settle on Base. We'll see a lot of it settle on Ethereum L1. And I believe that there is a underserved opportunity within Solana. And like, that's personally why I went over there. When it comes to capital efficiency though, the benefits that we're talking about compared to T+1, compared to like near instant settlement, are seen across L2s, L1s, all L1s. Like it doesn't matter. Even like Bitcoin with its, I don't even know, it's like 16-minute block times. I can't even remember. I was actually sending an L1 Ethereum transaction this morning. I was like, oh crap, I forgot it takes 12 seconds or so to confirm. But those benefits are conveyed as long as we have a shared ledger. So I'm less opinionated about L2s versus L1 or anything like that when it comes to comparing it to legacy infrastructure. When it comes to cool things that we're seeing across DeFi, across ecosystems, I think it comes back to specifically everyone is focused on reducing effectively the spread between the bid and the ask. So if you have a market, let's say a market for oil or USDC ETH or anything you can imagine, but let's focus on those two because those are real tangible examples. effectively what we're trying to do across the industry is minimize the spread or the amount between buyer and seller for a specific asset. Why are we trying to do that? We're just trying to create the most efficient market possible. And to me, like that's in the Solana ecosystem specifically, that is what we are focused on all the way from the protocol developers at Anza all the way through application developers at companies like DFlow. So as an example of this innovation happening, right? If you've used Uniswap or Aerodrome or Velodrome, you want to just put a me in the chat. Any Uniswap users, Aerodrome, Velodrome? I'm trying to think of the major dexes. Okay, Paul, Dora, great. Vivek. Okay, Dora, can I call on you? Can you, or actually, I don't want to call on anyone specifically here. Could someone speak up and share how Uniswap works between a buyer and a seller? I can also do it, but. V, you got it? All right. Okay. So how Uniswap? Oh, go ahead.
Yeah. So you have liquidity providers. They add liquidity to both sides of that token pair, and they say within certain bounds, you can use my liquidity to execute the trade.
Yep, exactly. And the liquidity or the price of that thing, whether let's say it's ETH/USDC, changes every block time, right? So if I'm something like Base where I have 200, 250 millisecond block times, that price is changing every 250 milliseconds. But if we come back to our thesis that crypto or blockchains are just capital efficiency improvements on the existing system, well, let's go look at an analog like Binance or Coinbase or even NASDAQ. Those prices, they're not updating every 200 milliseconds. That's way too long. They're updating every millisecond or less than that, right? So what is happening when we look at, like, let's just zoom into a window. Imagine in your head, there's 1 second, and then you have a 200 millisecond, and then you have a millisecond. If someone trades on that 200 millisecond, they have to wait another 200 milliseconds before the price gets updated, or right? So if I'm providing liquidity, there are 200 opportunities, assuming I'm trading on a centralized exchange, for that price to deviate compared to what the price was last quoted at, right? So I think a big opportunity is how do we improve that delta? So an example of how AMM researchers or DEX researchers are improving that is through something called a proprietary AMM. So rather than waiting for the next block time to update the price, they're using their own liquidity and they are updating the price or the quote that they're willing to sell ETH/USDC at intra-block, so within block times. So what does that result in? That results in a price that resembles more specifically what you're seeing on centralized exchanges. It results in a tighter spread between the bid and the ask. And ultimately, that results in liquidity providers, which are helping the system go, or you can effectively think about them as market makers. It helps them be more profitable, or more specifically, lose less value. So I think, to me, coming back to, hey, this thing is a capital efficiency unlock, when we really look at a basic example of just swapping value, crypto has been the antithesis of that compared to centralized analogs. I think today we're finally seeing the emergence of new AMM primitives that are resulting in those capital efficiency gains being passed down to users, getting better prices, as well as liquidity providers or market makers being more profitable.
Amazing. Thank you, Zain. I think that you represent, like, you specifically and the work that you focus on represent one of the largest trends in crypto. And we appreciate you going through it in depth today. Know we're at time for what we had for you. Really appreciate the time you spent. If you have any parting thoughts, would love to hear them.
Yeah, I think Vivek, you called it out in the beginning. This is a ripe opportunity for people building companies to effectively have generational outcomes. So the world is coming on chain, as Jesse would like to say. Use this as an opportunity to make your mark in history. If you have any questions, need connections on the EVM side or Solana side, please please feel to reach out. I'm like, unfortunately, always online. You can reach me on Twitter, super easy, or Farcaster. And I think it's just at Zain on Farcaster. But thank you so much for the opportunity, and thank you for the phenomenal questions.
Cheers, Zain. Take care. Take care. Thank you so much. Good deal. We have a little more time for Fireside, and I'd love to hear from anyone. We could go back to some threads that we started, or start new ones. I think that I would like to represent, you know, Zain comes from a very specific focus on efficiency, and I think that it's kind of like an interesting and clear path that leads him towards the Solana ecosystem, where there's a lot of valuable and rigorous work being done on basically every single millisecond, counting. I think that the convo with Nitesh and Kaveh also represents like a whole other area that I think Kernel with this module and overall has been curious about, which is on like what are these new forms of money, that could have different issuance structures and could return back to some of the previous patterns that money has had well before the US dollar. And so there's just a lot of different levels at which we can approach this type of discussion, and welcome any thoughts, critiques, or questions that people have with the time that we have left.
I can go, but I don't want to monopolize the conversation.
I think it's okay. Feel free to kick us off, Nitesh. Please, anyone else, feel free to chime in.
I think the thing with efficiency is I've heard the story in the context of antitrust, right? Ever since the 80s, kind of the US shifted from delivering outcomes to businesses to saying as long as we make the market more efficient, we deliver goods at lower prices, that the consumer welfare will be served. And we've ended up in a place where actually products now are as cheap as they get, but consumers are still, they've just shifted to actually harvesting our attention instead. So that's my concern from, the improvement. We might get faster payments, but if what we're getting at the other end of the payment is not going to hold its value, um, are we really improving the financial system? That's where my skepticism comes from. I mean, it's not a criticism of Zain or the work that he's doing. It's just like a broader question about where this is going. I'm wondering where to put my money, for example, right?
Absolutely. Absolutely. I think it's very well articulated. Anyone else?
So I actually want to like do a controversial thing. Right now, there is a service called TransferWise, like wise.com. I don't know if anyone used it.
Yeah.
I use it often, and when I send money to a friend or family, they receive it in like 5 seconds, like in their bank account. So when crypto gives examples of like how it's going to like optimize the current system, it always gives the examples of an old non-working traditional system like a Swift transfer where you receive the money in 5 days or like whatever. But there are solutions in like the traditional finance that is very advanced than I mean when I transfer you some money like I have to first have money on my bank and then put it on Coinbase and then transfer to you, and then you probably have to like transfer that somehow to your bank, which is like a lot more than 5 seconds. So I guess in to make this work, like banks and blockchains should be working together, and that makes like kind of the dream of blockchain replacing banks not feasible, I would say. So you still need to get your money somehow, right?
Mm-hmm. Mm-hmm.
So in that sense, you need a bank or something like that, I would say.
Yeah. Even in the case where, let's say, you know, your base wallet gets so good that you can make payments directly from it, and the $5 comes in 250 milliseconds instead of 5 seconds, and when it gets to your account, it's automatically earning 4% because Base has set that up. The efficiency gains, I think that it is true that the traditional solutions already are quite efficient. It's also true that they can be made more efficient. But I am compelled by Nitesh's commentary too, that like goods and the style of money that we use, like there are possible innovations in other directions. I think it perhaps for me, I feel myself like wanting to learn more about the history of banks um and try to understand like their role a little more clearly than just as like people that help move money, but this like issuance um and other factors related to issuance of money and credit.
Yeah, and I think this goes back to a conversation we had in week one between whether we look at this as currency or an asset. And I think we're in these conversations, we go in and out of talking about these as currency sometimes and asset sometimes. And that's partly because after the US dollar replaced the gold standard, US dollar is both an asset and a currency. And that's part of the problem, right? Because we're chasing different incentives at different times. Um, that's just an observation. I think this is probably need to have a longer conversation there.
Mm-hmm. Mm-hmm. Yeah, I was also reminded that even the construction of the Federal Reserve at this point, which is balanced by these considerations of currency or asset as well, where you know on one hand you're trying to keep unemployment low, and on the other hand you're trying to keep inflation low. Let's say those also have this type of balancing force between currency and asset. The creation of the Federal Reserve, the creation of modern banking, it was not created with those two stated goals. The Federal Reserve was created to bail out the banks. That was the actual historical reason why it was created. And then after the fact were these two mandates added on and now taken as the reason for the entity's existence. But in practice, it was the banks needed to be bailed out. And it was very true that if they were not bailed out, if their debts were not cleared, it would have been much, much worse for everyone. And so we can agree that maybe it was the best of bad options at the time. Maybe maybe there is some disagreement there, but it is just worth noting that the creation of the Federal Reserve um, is fraught with some of this history as well. Skele, I think you added a post about efficiency. I would love to hear if you're willing to share why you added it.
Yeah, hey, so that's a nice tweet about the trade. I think it was a few $1 million that basically just cost $2 to settle from Ethereum to Plasma. And that talks about efficiency And it also talks about kind of some of the limitations, besides some obviously geographic restrictions, that the actual payment system that we all use on our daily lives has. Obviously, it might be simple or very easy to just send a few $100 or $1,000 to a friend from your, say, crypto neobank to their bank. But once you start trying to move huge sums of money as a corporation, then the system breaks entirely. So that's also one of the things that maybe doesn't have a lot of attention, or doesn't get a lot of attention, because people are kind of worried about, let's say banking, people that maybe will move less than $1,000, right, monthly, or etc. But sometimes these huge opportunities, as we were talking before, with banks and with clearing houses that literally clear like billions and billions of dollars, usually they go unnoticed. And those are the things that are, in my opinion, being built in the shadows, or the Web3 corpo startups or companies will start seeing this next year, and we've started seeing this year as well. That will honestly kind of start eating the Web3 native lunch a little bit.
Yeah, Skelly, on one hand, I want you guys to meet the Cycles folks, because I think Wonderland and Cycles working together would be like a dream for me. Do you want to expand on like this this next phase that you're imagining? I think that I understood it, but maybe at the end there, when you were bringing up eating the Web3 natives lunch, I think I lost a little bit where you're going with what you imagine this next phase to look like. One reason I say that is because like my instinct is to try to move in the direction like Ethan is going towards these more like hidden roles of banks in these very like large transactions or large clearings of debt. This like banks can just go and talk to each other and clear billions and billions of dollars of debt. Seems like we should build systems that don't just solve for move $5 from one account to the next account, but be able to credibly compete with these large structures on some of these like shadow capabilities of these banks. So on one hand, I thought you were going in that direction, but then on the other hand, you're saying maybe eating the Web3 natives lunch. So I want to know where you are between those.
Yeah, definitely. So, I mean, the part of building the technology, it's already there. Obviously, banks and those institutions will move extremely slow compared to Web3, or even like these crypto native banks, etc., right? But honestly, once the once they start adopting these technologies that will enable them to lower their cost extremely, I'm not sure if they, or even if someone will be able to compete with that amount of volume. Like, even if they use an open system, let's say, which honestly I don't think they will, they would just have like a proprietary blockchain between a shit ton of banks, similarly to what they have right now, just cheaper for them to run, right, and faster, and etc. So you as an end user will still be using your bank as it is right now, but it will be as cheap or even free compared to, let's say, the Web3 native solution, right? So that's kind of my point. Not sure, besides, I don't know, a few select group of people that are, let's say, more ethos align with, I don't know, hey, I don't want my money to be on this like bank blockchain or whatever. Yeah. So that's the thought
Thank you.
line that I
Thank you.
was having. Yeah.
Thank you. That does clarify quite a bit. And it's nice to be pragmatic about what's likely to happen, and then we have some opportunities to kind of compete still, or do new and different things depending on where we as a space, a crypto native space, place our future attention as well. I think that's where, like, for me, Cycle's work is still so inspiring, personally, because it takes us like away from the space where the banks are paying immediate attention. I say, I think that there's something fresh there, and the innovation is required. Cool. We're at the top of the hour. We can continue on if anyone has any further thoughts